Welcome to our channel. If you want to invest in index ETFs, follow these step-by-step instructions to build a simple, effective portfolio that tracks market performance. Step 1. Understand how index ETFs work by passively tracking a specific market index, like the S&P 500 or total stock market. These funds automatically adjust holdings to match the index with minimal management required. Step 2. Choose between different types of index ETFs, including broad market funds, sector-specific indexes, international market trackers, and bond indexes based on your investment goals and timeline. Step 3. Compare similar index ETFs by examining expense ratios, assets under management, and tracking error. Even small differences in costs compound significantly over decades of investing. Step 4. Open a brokerage account that offers commission-free trading on your chosen index ETFs. Many platforms now charge no fees for ETF purchases, eliminating a significant drag on returns. Step 5. Determine your asset allocation between stock and bond index ETFs based on your age, risk tolerance, and time horizon. Younger investors typically maintain higher stock allocations than those nearing retirement. Step 6. Invest regularly using dollar-cost averaging to build positions over time regardless of market conditions. Consistent investing removes emotion from the equation and takes advantage of market volatility. Step 7. Rebalance annually to maintain your target allocation as different index ETFs grow at different rates. This discipline forces you to sell high and buy low by trimming overweight positions. Don't forget to like this video and subscribe to our channel.